Hi, everybody. How is it that two retirees can earn the exact same average return, yet end up with completely different retirement outcomes? We all know returns matter, but the when or sequence is the X factor that can literally make or break your retirement. Here are two different 30-year retirement scenarios with starting dates separated by only 2 years that range from broke after 23 years to $5 million left and still going strong after 30. How did that happen? Let me show you. Let's say a retiree invested in a simple portfolio, 50% S&P 500 index and 50% 5-year U.S. Treasuries, rebalanced annually. And let's test how that portfolio performed over rolling 30-year retirements using actual historical returns. Here are the inputs. Now here's where things get interesting. Remember the 1973 retiree scenario I showed earlier? Their portfolio was completely depleted after just 23 years. Game over. But what if that same person retired just 1 year later in 1974? Completely different outcome. They successfully generated income for the full 30 years and still had more than $850,000 remaining at the end. And then it gets even crazier. Remember 1975's retiree? Not only did their portfolio survive, it finished with nearly $5 million remaining. Same portfolio, same initial withdrawal, same retirement length. The only thing that changed was the starting year. That's sequence of returns risk. Early market returns matter disproportionately when you're withdrawing income from a portfolio. And unfortunately, no one gets to choose the sequence they experience. If you'd like to discuss sequence of returns risk in general educational terms, please contact us. Any discussion of your personal situation would be subject to a separate review of your circumstances and applicable advisory disclosures. All content presented is for educational purposes only and should not be construed as a solicitation or offer to sell securities or provide investment, tax, or legal advice. All examples are hypothetical, for illustrative purposes only, and are merely arithmetic calculations. They are not representative of the performance of any type of investment, security, or strategy offered by the firm. Past performance is not indicative of future results. Investing involves risk, including the potential loss of principal. Hypothetical returns do not reflect actual trading and may not be indicative of the performance of any specific investment. They are based on assumptions and estimates that may not be accurate or applicable to your individual situation. Always consult with a qualified financial advisor before making any investment decisions. Additional information, including management fees and expenses, is provided on our Form ADV Part 2, available upon request, or at the SEC's Investment Advisor Public Disclosure site, www.advisorinfo.sec.gov.